everybody, as you're coming in. Hope everyone's day is going well and having a little maybe break on your lunch hour with us this nice day. Spring is approaching. Okay, well, I'll just say a few words before we turn it over to Taylor. I want to be very cognizant of everybody's time, especially on these lunch and learn type of events. I know we all have very tight schedules every single day, and your time spent with us does mean a lot to us. So I'll introduce myself here. My name is Natasha Phipps. I am the CEO and co-founder of WealthShare. We are a private real estate investment trust here in Calgary, Alberta. And I've also been a landlord for over 20 years here in Calgary myself. So, state of the rental market, CMHC's data, all of those factors are really critical uh, elements that we look to when we're making decisions as investors. And so we are really excited to have Taylor here today with us to not just tell us what to look forward to, but also a bit of a review as to where we've been the last year and where we think things are going in the coming year here. So thanks so much for being here with us, Taylor. I am going to unpin myself. And I know I always get the question, are we recording this? Yes, we are recording this. So if you registered, you need to pop out, no worries. We will send out the recording to you after if you did register. So with that, I'm going to turn it over here to Taylor Pardy from CMHC. Thanks so much for being here, Taylor.
Absolutely. Thanks for having me. Um, yeah, thanks Natasha and to WealthShare REIT for having me speak here today. As Natasha said, I'm going to do a bit of an overview of what sort of factors some of the economic, demographic, financial factors that are influencing the market right now. And I'm going to do a bit of a overview of that first before jumping into some of the rental data and what we've seen based on our most recent survey that we conducted CMHC. So I'll just jump right in. So I'll start off talking a bit about, obviously this has been on everyone's mind over the past month, the war in the Middle East and how that's going to play out essentially. And are we looking at sort of a short-term or a more drawn-out conflict and what that's going to mean for things like oil and gas prices, things like fertilizer prices, and how that translates down into food pricing, and ultimately how all of that translates into inflation and what we can expect for rates going forward. And so these are all things that are on our minds right now and things that potentially could have big influences on the forecast going forward. Obviously we've seen what's happened to oil prices in particular over the past month. We know that about even with diversions and to the Red Sea and things like that, about 10% of global supply flow has been taken off of the market. We know that over 40% of both urea and sulfur are supplied through the Strait of Hormuz, and about a fifth of the world's ammonia. And so, from that perspective, that is also very concerning. And so, we're currently starting to run some scenarios on how this, could play out, and we generally provide a mid-year forecast update. And so, depending on what happens in the coming month or months, we should be able to sort of try to factor this in and give you a bit of an update. Um, so things that are, I guess, a bit more certain and ongoing right now. Obviously, we have U.S. tariffs still in place. Fortunately, the impact was a bit more subdued last year, thanks to CUSMA exemptions largely. Um, we also had it did impact manufacturing to some degree in Alberta markets, including Calgary and Edmonton. Over the past year, though, we also, for a period of time, had Chinese tariffs in place last year that was impacting our export volumes, agricultural export volumes. But we actually, even while those were in place, started pivoting and we were finding new markets for some of that. But this is no longer as much of a worry given that a deal has been made there, and so we're actually going to see. Um, these volumes sort of normalize, and so that's a positive for the province. One of the main things impacting the rental market right now is we've seen, a fairly large change in approach to immigration policy, and so we're seeing that have a big impact on population growth right now in the near term, particularly on the international migration, temporary migration side of things. We know that local economies have been holding up fairly well, despite tariffs and the uncertainty over the past year. And we've actually seen some fairly strong full-time employment gains, particularly in Edmonton. And we're starting to see, we saw some softness in the latter half of the year in Calgary, but now we're starting to see things pick up again in terms of full-time job growth. So that's positive. We know investment in the provincial and local economies remains strong and ongoing, with upcoming major projects potentially helping to drive growth going forward. And so this is sort of besides, when most people across the country think Alberta, you think oil and gas, and that's going to influence how things play out in the province. But there's a lot of other things happening and a lot of other potential investments um, on the horizon as well. So, some of those major themes being AI data center investment. Obviously, there's a lot of, proposed projects in that could impact both Calgary and Edmonton in the near term. We have, major public sector investments. So you can think of things like the Calgary Events Center or the Arts Commons transformation, the LRT, phase one, Green Line, schools, as well as some investment at U of C. Obviously, municipal infrastructure investment, that's obviously a big one and had some, issues in the past few years, as well as other major commercial developments and things like office to residential conversions. There's a lot of things, a lot of different things happening at the moment, and a lot of investment projected out to 2030 in some of these areas. And so if we were to see things like, positive investment decisions in some key areas, like I mentioned, things like data center development, that would be only, I guess, um, add to things. Edmonton's very much, similar in this respect, and actually there's some larger projects like the Dow Chemical Path to Zero project that's moving forward now, and so that as that build out happens, that's also likely to stimulate some other investment too. Similar to Calgary, AI data center development is a big conversation right now as well as things like major public sector investments and the like. So just a lot of things potentially on the horizon and influencing what's happening in the province. Um, and as I said, we'll have to see what happens with the conflict in the Middle East and how that may change things as well. We know from a mortgage rate perspective and how that's influencing housing markets, they have come down over the past year, but they still remain at a higher level than much of what we've seen in the past 20 years. And so, that's going to impact decision making of, whether to remain in rental or move into ownership for some households. And I'll touch more on that in a minute. So to jump into, obviously one of the main factors influencing the rental market right now is the rate of population growth, and how that is slowing, particularly given some of the changes in immigration policy that we're seeing. So Calgary went from about 6.2% growth in 2024 on a year-over-year basis down to, approximately 3%. Edmonton went from about 5.2% down to roughly 3% as well over the past year. But that magnitude of decreases, certainly not to the degree that we're seeing in some other markets in Canada. So, the goal or I guess the policy target outlined by the federal government is to bring the temporary resident population down to about 5% of the overall Canadian population. And we know that some provinces like, Ontario and BC were sort of well above or, punching above their weight in that respect prior to this policy implementation. And so they're seeing a more drastic, um, yeah, drawdown in that rate of population growth. And in fact, Toronto actually went slightly negative um, over the last year, and Vancouver wasn't too far behind just due to this adjustment. But Calgary and Edmonton are faring a little bit better in that sense, particularly. So a couple of things, generally having a younger population and how that contributes to natural population growth. That is, adding to some positivity, but also interprovincial migration is still net positive, even though it's come down a bit over the past year. We're still seeing net positive gains from um, pretty much everywhere else in Canada at the moment. And so it still sort of speaks to the affordability advantage and opportunity that Alberta markets are sort of offering at the moment. We're still seeing that positive flow. International migration. So this is just a chart showing, how things have translated, particularly on the right-hand side of the graph in the last, 5 years. You can see how, we had that big surge, and now we're really clamping down to the point where net international migration as of the fourth quarter was effectively zero. It had shrunk to effectively zero based on how much the outflows of temporary residents were, or non-permanent residents, offset the positive of permanent immigration, so new citizens and permanent residents. Um, and so what this tells you is that the far right-hand side of the graph, those last two bars are, Q3, Q4, 2025. Those would have not been included in those population estimates that I just showed, because the way it works with StatsCan is it's sort of a half year to half year estimate. So Q3, Q4 wouldn't have been included in that population growth rate. So what that means is that 2026, or when we get the next data point, it's going to come in lower. Essentially, we expect 2026 to be the year where that policy bites hardest, essentially. And so before we start to see a bit of recovery in 27 and 28, or some normalization in international migration. And so this is just I guess, a chart showing how much net non-permanent resident outflows are sort of offsetting the permanent immigration side of the equation at the moment. And so why is this happening? Essentially, non-permanent residents, we have folks who are work permit holders and study permit holders, as well as asylum claimants, perhaps fleeing conflict in other countries and have claimed asylum. But most of the outflows, or basically all of the outflows, is coming from folks who had work or study permits who maybe finishing their studies and are leaving and returning to their home country, or somewhere else for that matter. Um, and so this is likely to continue, as I said, for a period of time, next year and a half or so. On the labor market side of things, even though we're seeing the population growth rate, slow fairly significantly, we've seen, the unemployment rate in Calgary and Edmonton like holding fairly steady, and maybe, starting to look like they're actually moving downward a little bit. Um, Calgary and Edmonton have done, from a full-time job growth perspective, are doing okay. Well, Edmonton's doing pretty fantastic at the moment. Calgary's sort of rebounding a bit after some weakness due to not only tariffs and impact on manufacturing, but also there were some announced layoffs from some of the larger oil and gas companies like ConocoPhillips and Imperial. In the fall of last year, and so that started to influence things as well on the job side. But as I said, going into the early months of this year, things are picking up a little bit, and we have about 2% job growth so far this year in Calgary. But very different story if you were to look at, the prairies, there's, markets that are sort of showing resilience and from a full-time job growth perspective, there's markets that are doing well, really well. Regina on a year-over-year basis is doing pretty well at the moment. But if you were to look at, Toronto or Ontario in general right now, when you think about higher interest rates and how that's impacted the housing market in recent years, but also, pile on top of that the impact of tariffs and how Ontario is a bit more exposed in that respect. And you have a situation where things are, even in the larger markets or the largest market of Toronto, things are looking a bit weaker at the moment. Um, Mortgage rates, how that's influencing things. Well, if you consider where rates are at right now and you look at things from a perspective of mortgage borrowing capacity and, as a multiple of your income. So essentially I've mapped this out over the past, going all the way back to the year 2000, and how much you could essentially affordably borrow as a multiple of your income over time. And, we're in a situation where, borrowing capacity is similar to 2006 levels right now. And we also were in a bit of a rate hiking cycle at that time. The economy was running a bit hot. Commodity prices, particularly in 2007, really started to surge. And so things, the hiking cycle got even more tight after that. And so, if you're a potential buyer at the moment, and we have seen price increases, particularly in Calgary, fairly strong price increases in recent years, you're still facing a mortgage rate that's not, particularly low compared to the past, 25 years, where a good chunk of that period of time, you could affordably borrow a lot more or afford more house, essentially. So that being said, and given, current conditions in the rental market, where it is more competitive, there's more supply coming online, and we have this sort of downshift in demand, downshift of a major source of demand. Um, on the rental side, if you're a renter right now, you may actually be considering, okay, it seems like it's a bit of a tenant's market. Um, and so, the people may be making that trade-off right now of, okay, do I jump into ownership right now or do I rent for a bit longer? That sort of calculus is likely happening right now. Um, so jumping into the rental market numbers and what's happened, I'll start off provincially and then we'll kind of drill down and we'll do a lot more focus on Calgary and Edmonton as we go. But if you look at the province as a whole, we saw about a 6.7% increase in the rental stock over the past year. And in a historical sense, that is quite strong. The past couple of years have been quite strong in general. And so, how this is translated is we've actually seen the vacancy rate on a provincial level increase to about 4.3% relative to just a little over 2% a few years ago. Um, so, where have we seen this supply or this expansion in supply happen? Well, it's largely in Calgary and Edmonton. We've seen a couple hundred units come on in Lethbridge over the past year, and that's sort of provided some relief from a vacancy rate perspective. But like on in percentage terms, and how and in volume of unit terms and how that's contributed to the overall Alberta number, it's really Calgary and Edmonton that are sort of the dominant markets right now for rental. So Calgary with 11% growth, saw 10% growth last year as well. So a couple really strong years for Calgary. Edmonton with about 5.6% growth in the rental stock over the past year. The in percentage terms, it's a little bit something to keep in mind is that it's a little bit deceiving in the sense that we didn't see about half the amount of rental come online as Calgary saw in Edmonton. Edmonton actually has quite a large purpose-built rental stock overall. It's over 90,000 units, whereas Calgary's more like 62,000 apartment rental units. So big difference there. And so when you look at the number of units added over the past year, it's more like it's about 4,800 in Edmonton versus about 6,200 in Calgary. So that the difference isn't super stark, and not as stark as the percentages would suggest. Um, so, how did this influence vacancy rates? A lot of supply came online in Calgary for the second year in a row. But what's interesting is we didn't see the vacancy rate change all that much. And actually, um, at 5%, it's statistically unchanged. There's no statistical difference between that 5% and 4.8% last year. So it remained flat. Whereas Edmonton, we did see a bit of a bump upwards, given that the amount of supply coming online has actually accelerated relative to last year. Edmonton seems to be about a year behind in terms of the trend and where things are going. It's sort of the trend that we're seeing in Edmonton this year is what we saw in Calgary last year. Um, and Lethbridge, as I said, we saw a few hundred units come on that provided some relief in terms of vacancies. And then in other markets where we didn't see any supply increases, particularly smaller sort of energy industry dependent centers, or centers that act as major sort of service centers for the energy industry. We saw a bit of an uptick in some markets. So Medicine Hat, Red Deer, Wood Buffalo, which is Fort McMurray, and Lloydminster a little bit. But the thing to note, I guess, with all of these markets is that these vacancy rates, for the most part, besides Fort McMurray, are still, fairly low. So in terms of what happened with average rents and how much of an increase we saw on a year-over-year basis, um, on the left-hand graph is just sort of the year-over-year change in percentage terms in average rents across markets in Alberta. And so what we saw in Calgary, given that the vacancy rate is higher and has maintained at that higher level for the second year in a row, is it's a much more competitive market in Calgary right now, and so our estimates came in at that there was basically no change in rents over the past year. Rents were either for the most part, being held flat. Um, Lethbridge, same thing with that increase in the vacancy rate to 4.5%. Also, estimate came in at zero. Same with Fort McMurray. But we still saw, modest increases in Edmonton and some of the smaller markets where the vacancy rate is still a bit tighter. And then average two-bed rents I've got on the right-hand graph. And so, in addition to vacancy rates being a bit tighter in some of those, smaller markets like Medicine Hat, Grand Prairie, and Red Deer, average rents on the whole are still much lower than some of the larger centers, particularly Calgary. And this is just a chart depicting, rent growth versus um, the vacancy rate over time. And so you can see, Calgary 0% rent growth on a year-over-year basis, 5% for roughly 5% vacancy for a couple of years seems to be, um, the level that sort of has stabilized rents or brought them to zero essentially relative to the high of over 14% growth in a single year just a few years ago. Edmonton, same graph, just shows the inverse relationship between the vacancy rate and average rent growth over time. So given that Edmonton isn't at a vacancy rate yet, that would I guess sort of stabilize rent levels or even lead to a bit of a decrease or anything like that. Um, yeah, it's just not there yet, but we do expect, as I mentioned earlier, vacancy rates to sort of move upwards over the next few years still, just given, some of the factors that I had mentioned at the beginning and all of this new supply that's set to come to the market. Um, This is just breaking down where did we see um, increases in the rental stock across the city of Calgary, and it's fairly well distributed for the most part, but we saw the biggest gains in some areas where there's been a pretty significant build out. So thinking like the southwest, southeast, northwest, we did see a fairly large increase in more of a central area like Chinook, as well as some modest increases in more central areas of the city as well, including the Beltline and downtown. But largest increases in I guess more of the periphery for the most part. And so this is an interesting graph in that, we saw this is just purpose-built apartment vacancy rates by year of construction over time. And so you can see different how things have translated in different cycles over time. Um, what's interesting is we saw the largest increase in vacancy rates happening in, older units built prior to 1960 up to 1979. And so what's interesting about this is we at the same time, given that we've seen all, despite that we've seen all of the supply come to the market, vacancy rates for units built 2000 or later, which would include that new supply that's been added, actually decreased. So what it says is that people are likely, moving around the market. We know there's lots of, really good incentives on offer at the moment. And so people are sort of incentivized to move around the market a bit more. And so we're seeing, this is generally a positive sign when you think about the long term and how you sort of maintain affordability and how new supply contributes to maintaining that affordability. You need people to be able to filter through the market essentially, and create what's called vacancy chains, whereby folks leaving those units, let's say built in 1962, moving into something um, a bit more new, let's say built in 1990, 1995. That frees up a older, more affordable unit for somebody else to move into essentially. And so as this process translates over time, uh, and as long as there's enough supply available for people to be mobile and move around and sort themselves into a housing situation that, may be more affordable for their household income and hopefully, suitable for their family. This is how you sort of how new supply helps to maintain affordability over time. And so it's interesting that, we see these trends in the data, and to me, it's a positive sign and a sign of, healthy dynamics in the market. Um, when it comes to Edmonton, so I'll show the same few charts for Edmonton. Where did we see expansion in the rental stock? Fairly broad-based, spread across the city in Edmonton. But we did see, notable increases in some areas where we're seeing more of a build out. So in the uh, southeast, Millwoods area. Um, uh, but yeah, for the most part, fairly broad based. And we actually saw, a fairly strong increase in downtown as well, which was interesting. And so same graph that I just showed for Calgary and when I was talking about new supply and affordability. Edmonton, as I mentioned earlier, is I would say about a year behind in terms of the trend relative to Calgary, but we did see a bit of increase in vacancy rates for some uh, uh, older units, particularly built between 1960 and 1979 and 1980 and 1999. But we didn't see the decrease that we saw in Calgary for newer units built 2000 or later. Um, and so, bit of a difference there in terms of both, movement and vacancy rate trends. But what's interesting in Edmonton is that the vacancy rate for units built before 1960 actually remained low and flat. And so, to some degree, it speaks to the fact that perhaps folks are prioritizing affordability and keeping their expenses low at the moment, particularly since, fall pandemic, we had that big surge in inflation, and inflation tends to, impact lower income households a little bit more acutely. What it speaks to, the ongoing affordability challenges related to those things, and how that inflation, continues to um, impact folks essentially, even though it's sort of come down and it seems a bit more stable now. I mean, the price level is permanently higher, though, for a lot of things. And so this is, breaking down vacancy rates by, different areas of the city, and we saw broad-based increases across the city of Calgary. Um, for the most part, some areas, seeing a bit tighter conditions, at least as of, when we surveyed, including, the southeast, still under 3%. But on the whole, taking the average across the CMA, including, Zone 10, sort of surrounding areas around the city of Calgary, being a bit lower as well, we ended up with 5% overall. And then same thing for Edmonton, apartment vacancy rates by zone within the city, um, as well as different areas of the CMA. We did see pretty strong vacancy rate increases in some areas where we've seen a stronger build out actually. So the Millwoods area, southeast portion of the city, West Jasper Place, which is sort of to the southwest. Um, we saw fairly strong increases there, and for the most part, increases across the board. This is just breaking down average rent changes in percentage terms on a year-over-year basis. For the city of Calgary, breaking things down by zone, similar to the charts I was just showing. And what's interesting is for Calgary, like across the board, regardless of where you were in the city, our estimates came in at zero. Like essentially, rents were being held flat over the past year when you're looking across the entire rental universe. Edmonton, similar chart, breaking things down by different areas of the city. We saw the percent change in average rents on a year-over-year basis decrease in magnitude, sort of across the board, no matter where you were in the city. And we actually saw some parts of the city where we saw zero estimates of 0%, changes in rents. So as things are sort of as conditions are loosening in the Edmonton market, we're already starting to see um, things getting more competitive on the rent side of things. In terms of the rental condo segment, we've seen Edmonton has seen a fairly significant drop in recent years in our estimates of how many condos are being rented out for long-term rental. Whereas Calgary's been sort of a slow, steady downward trend. Um, and given the volume of supply that we've seen, particularly in the past 2 years coming online in Calgary, and sort of how competitive things are right now, we have seen the vacancy rate in the rental condo space actually increase on a year-over-year basis to 2.2% from being fairly tight, just a year ago. Edmonton, on the other hand, a lot of units been taken out of the market in recent years. We did see a bit of an increase in our estimate this year. But for the most part, given that units have sort of been exiting the market or not being used for long-term rental anymore, um, the vacancy rate still remains fairly tight at 1.7%. So, speaking of people sort of, not using their units for long-term rental anymore, part of the reasoning behind that is likely in the past, few years, I'd say 3 years, it has been a fairly liquid market in that the pace of sales has been quite strong in both of these markets. And price increases, particularly in Calgary, exceeding previous peaks, have been fairly attractive. Edmonton, got up to its and just slightly exceeded its previous peak as well before, seeing a bit more softness recently. Um, and so, if you were an investor and had, bought, a decade or two ago, and you were looking for an opportunity to get out, I mean, in the past few years, it would have been, a good or advantageous time. You would have been able to sell fairly quickly as well. So, and it looks like that's sort of what's happened, and anecdotally, what we've heard is that that's sort of been the case. Um, in the rental condo space, however, they still, command a bit of a premium relative to purpose-built rental in both Calgary and Edmonton. So this is just breaking down average two-bed rents, different areas of the city, or areas of the CMA. Um, and, for the most part, we see, average rents that are just generally higher. And this sort of speaks to uh, the difference in age largely and potentially amenities as well. So if you were comparing sort of a condo built in the last 20 or 30 years to a purpose-built rental built in 1960, you'd have a difference in those units in terms of amenities, perhaps location, things like that. And so there is a premium associated with the rental condo space still. But that has been shrinking and is likely to continue to change just given the volume of purpose-built rental that we're seeing come to the market right now. And they're obviously going to be coming to the market at higher rental rates. However, the rent premium for new um, rental stock has, shrunk by about half relative to last year in Calgary, as that new supply coming to market is competing aggressively for tenants. So the premium on average for a newer unit built between 2022 and 2025 relative to the overall rental stock, including everything going back to 1960 or beforehand. Um, it was only about 16% in Calgary over the past year, where it was over 30% last year. Edmonton is still a premium of about 26%, which was a bit higher last year. But as I said, it hasn't reached that higher vacancy rate yet and hasn't been maintained for as long as Calgary. But there is, as more completions happen in Edmonton, I mean, we'll see the same sort of trend happen in Edmonton in the coming few years as well. Rents, year-over-year change in rents in percentage terms for units that turned over or where the tenant moved out, not really much of uh, a change there. It's relatively marginal, upon turnover in Calgary and Edmonton, and it's a trend that we see for the most part across the prairies. Saskatoon is still is a bit of an outlier in this data this year, but so yeah, as I was saying, really, what we see in terms of the difference between the prairies markets, particularly Alberta and Saskatchewan in this graph versus say Toronto or Vancouver, is it's a difference in regulatory uh, environment. You still have, even though vacancy rates are increasing in Toronto and Vancouver right now, you still have a situation where if you've had a unit for a number of years that has been, subject to, a rent increase guideline each year, and the market rental rate has been sort of continually exceeding that. You still have units that are turning over, and when that turnover happens and you reset to the market rate in these cities, it means that the rent is jumping quite significantly. And so that's essentially what this graph shows, is just differences in um, the regulatory environment, and it has implications for things like mobility as well. We see much lower turnover rates in, I guess, outside of the prairies, and in Vancouver and Toronto, for example. Um, This is under construction, the number of rental apartments as well as condos in the dotted lines under construction in Calgary and Edmonton. There is a lot underway. Historically, large amount underway in the ballpark of 12,000 or above 12,000 in Calgary and about between 85 and 9,000 units in Edmonton as well. And so there's a fairly large pipeline that's still set to come to the market over the next few years. And so that's going to have an influence on vacancy rates. And we can see that, completions have been pretty consistently strong in Calgary. They've been a bit more up and down in terms of project completions in Edmonton, but the volume overall of units that we're seeing coming to market in both these cities is quite strong and expected to be quite strong in the coming years as well as there's a lot in the pipeline and um, there's projects that are still getting underway essentially that were sort of through um, essentially almost shovel ready by the time we were doing our forecasts. Still a large volume of them, and so we expect that a lot of these will go ahead as well. And so, what do we expect over the next few years? As I said, we expect vacancy rates to continue to rise. So this is Calgary. We expect them to peak at over 6% in 2027 before we start to see things start to move downward, especially as we get to the end of the sort of immigration policy adjustment that we're going through and things normalize there and that source of demand, comes back. Um, but in the meantime, just given that's all the supply coming to the market and we're seeing slower demand flows at the moment, that's going to contribute to higher vacancies, at least for the next few years. But I want to stress this again, as I said previously in the presentation, demand growth has, slowed, but it hasn't disappeared. And so the result will be, longer lease up times as units come to market. Um, and, it's going to be more competitive in terms of filling those units. But we're really going through largely a policy related adjustment, and we know that that is going to normalize, in the next year and a half. And so, a little bit of, higher vacancies in the near term, longer lease up times, a little bit of, perhaps more work and a little bit more pain in the near term. But we know that that's going to end and things will stabilize, and we'll likely see international migration reflect a little bit more, um, the 2010s period of time where things are just a bit more stable and consistent in terms of those population flows. And similar story, very similar story for Edmonton. We do expect vacancy rates to rise, but we expect vacancy rates just given that the flow of completions in Edmonton, we appear to be, about a year behind Calgary in terms of the flow of completions and how this is translating into higher vacancy rates. And so we expect vacancy rates to sort of move upwards and then kind of stay there for a little bit before, perhaps beyond 2028, starting to balance out a little bit. A lot of, just to end off, a lot of, um, uncertainty related to this, obviously, given the war in the Middle East, and we don't know exactly how that's going to translate. But we'll hopefully, have a bit of a mid-year update for you, and we'll maybe know a little bit more how things are going to translate, depending on how the next month or so um, goes. So keep an eye out for that. So maybe I'll leave it there and pass it back to you, Natasha, and then maybe we can take any questions if folks have any.
Fantastic. Thank you, Taylor. Thank you so much for being here, by the way.
Absolutely.
It's a privilege to hear you today and take time out. I know you're a very busy guy and coming to speak to us today does mean a lot. So thank you so much. I hope everybody enjoyed
Absolutely.
that. And yeah, go connect with Taylor on LinkedIn as well, and follow along there too.
Definitely.
Yeah, we can certainly do a few questions if there is anyone who would like to ask a question.
Sounds
I'd
good.
like to find out, is there a differentiation between the possible rent that is received by a landlord between what some realtors sometimes call a one bedroom and a den, but the den doesn't really have an outside window. It's got sort of a window into a hallway. Is that considered a two-bedroom rental or is that considered a one-bedroom rental?
Well, I think if the den portion is not, enclosed with its own window, and perhaps a closet kind of thing, I don't think it would be considered a two bed or classified as a two bed. It would most likely be classified as a one.
Because I do know when they go on the market, many of the realtors are calling that a two-bedroom unit, even
Hmm.
though there is an opaque glass window onto the hallway, hallway in the unit.
Hmm.
I've seen
Okay,
those
well, odd.
on larger, like high-rise type buildings, I think is maybe what you're referring to. And I know a lot of the builders also refer to those as two bedrooms if they meet fire code to be considered a bedroom is how the builders communicate that as well. So I know exactly what you're talking about, and it certainly does make the data a little challenging because obviously that's not the exact same as two bedrooms with two windows and that. So
Yeah.
that's a fair point.
Yeah, because for investors who are purchasing to rent out, that does make a difference in what they can garner for rent in the end result.
Hmm.
Yeah, I'm seeing the same things with the listing it as a two-bedroom until people turn up. Whether that sticks, I don't know. But in terms of your observation about the older units, 1960 to 1979, being rented out at lower rates or different vacancy rates, a lot of that market for purpose-built rentals has been purchased by just a couple of REITs. And they are going for a very specific market segment. What I am seeing with people who are actually shopping for those is they're not competing head to head with newer units. What they're competing head to head with is basement suites. If you're
Mm,
in an
yeah.
older unit, typically you're going to have a lot of bad smells. Quite frankly, you don't have exhausting range hood fans, and they're not very pleasant to live in compared to some of the newer units. But when you go into a newer basement suite, you've got newer finishes, you've got your own controls, you've got your own door. And that is
Mm,
definitely it's a social issue, but I'm seeing that again and again and again. That's the head-to-head comparison. It's a basement unit with an older system.
hmm Yeah, and competing on rents with those, and I mean those have become um, quite popular as well in recent years, secondary suites, things like that. So yeah, I can see that for sure.
Question for you is, do you know of kind of where we're at with rent control happening in Alberta? Like, is that something that you kind of deal with, or you kind of know where things are moving towards, or if it's staying status quo?
Well, as far as I've seen, things look fairly. It has been discussed in recent years fairly extensively in the political arena and stuff like that. But as far as I can tell, it's fairly status quo right now. I cover all of the prairies, and so it's the same in Saskatchewan right now as well. It's been discussed, but I don't like it seems fairly status quo and not doesn't seem like it's going to change anytime in the near future anyway,
Okay.
unless
Yeah,
something
great. Thanks.
changes, obviously,
Yeah.
politically.
Yeah.
Good question. Okay, well, if there's no other questions, The only other thing I was just going to wrap up is just thank you so much again, Taylor. It's a pleasure having you, and this really is helpful for all of us. There's some takeaways there. If you're a landlord, if you own rental properties, it's going to get more competitive, and staying on top of your properties, how you're maintaining them, and the product you're offering, and all of those things really do matter as things get a lot more competitive. I did want to also highlight that next week we are having our spring mastermind event here in Calgary. We'll put a link here in the chat. This is another opportunity to have these conversations in person with us, the WealthShare team. And of course, we always have networking and a lot of learning along with that. We do have a special code for the guests here today for a 2-for-1 opportunity. If you're here in Calgary and you want to join us next Wednesday at the Spring Mastermind at 6 p.m., we would love to have you there. So I'm going to put the link to that in the chat here, as well as the code. But it's important just to highlight, if you're in our network here, we do a lot of events. We really believe in accessibility to information and to opportunity. So this is a really great example today of kind of getting people in a room and sharing information that is valuable and tangible and useful for us out in the marketplace. So thank you so much again, Taylor. And if you want to join us next week, we would love to have you. And we got lots of food and snacks, and it's going to be a great evening, as well as another economist speaking. Todd Hirsch will be there, and lots of opportunities to learn and connect and grow with others here in Calgary. Was there anything else you wanted to add, Taylor?
No, yeah, I just want to say thank you again for having me. Yeah, I thought this was a great session, and I hope you got some value out of it and can take some things away from it.
Absolutely. No, it's a lunch hour well spent, hopefully, for everybody here that attended. And we hope to see you at future events, everyone that's here with us today. If you do want to learn more about WealthShare as well, Michael has put his Calendly link in the chat. If you want to connect to learn about how you can get involved with WealthShare, this is a really good example of the community that we are building here. And you can invest in hard assets here in Alberta with $5,000 or more using your cash or registered funds. So it's a really great way to get involved, to get your capital working in hard assets that you can see, feel, and touch here in Alberta. But I will leave it here at that for today. And I just thank you so much for coming. We are coming up on the lunch hour, so we will sign off here. But it was a pleasure to see everyone today, and hope you have a great rest of your workday.
All
Thank you
right.
so much.
Thanks,
Thanks
everyone.
so much, Taylor. Thanks, everybody. Good to
Bye-bye.
see you all. Hope to see you next week at the Spring Mastermind.